Imagine this: the global economy shakes, markets tumble, headlines shriek, sell everything. But while fear is at its loudest, an opportunity stands quietly in the shadows, waiting for the bold. Today I'm going to show you how to position yourself so that when the next crash hits, not only do you protect your wealth, you use it to build fortunes. When markets spiral downward and fear grips every corner of the financial system, most investors instinctively run for cover. They liquidate positions, hoard cash, and wait for clarity. Yet clarity never arrives until prices have already recovered. History has shown time and again that it is precisely in those moments of collective panic when the seeds of the next great fortunes are sown. Fear, when properly understood, is not a signal to retreat. It is a signal that opportunity is emerging. The market is an emotional machine in the short term and a compounding mechanism in the long term. When emotion reaches extremes, the rational investor must stand apart, observing where sentiment has driven valuations far below fundamental reality. What drives these opportunities is not just price dislocation, but psychological overreaction. Investors forget that economies evolve, technology advances, and innovation never stops simply because markets are falling. Fear clouds perception. It convinces people that today's pain will persist indefinitely. But human progress is exponential, not linear. Even as headlines scream of collapse, entrepreneurs continue to innovate, engineers continue to build, and visionaries continue to push boundaries. Crashes, therefore, become moments when extraordinary ideas can be acquired at ordinary prices. The key lies in resisting the herd and trusting data, conviction, and long-term vision over short-term noise. During severe corrections, correlations often break down. Quality assets get sold alongside speculative ones because liquidity becomes the only priority. That's when the patient investor has the advantage. While others sell what they love to cover what they fear, disciplined capital quietly accumulates future winners. History is full of examples. Companies that redefined industries were born or accelerated during crises. Those who had the courage to allocate when uncertainty was highest captured exponential growth when recovery began. The market's memory is short, but its rewards for those who endure are immense. It is essential to remember that fear compresses time horizons. Investors who once claimed to have 10-year outlooks suddenly behave as if tomorrow will decide their fate. That compression creates mispricing. When investors sell innovators or strong balance sheet companies simply because they need cash or can't tolerate volatility, opportunities surface in plain sight. These aren't just temporary rebounds, they are generational entry points. Recognizing that distinction requires both patience and perspective, the question is never how much worse can it get, but what value is being created that others are too afraid to see. Capital deployed amid panic compounds faster because it starts from a position of deep discount. But courage must be matched with preparation. You don't build conviction during a crash, you bring it into one. That means understanding which technologies, sectors, or ideas have long-term inevitability. Disruption does not pause for recessions, it often accelerates through them. As traditional players pull back, innovators gain market share, talent, and attention. The investor who identifies these long-duration growth trajectories and uses periods of fear to scale exposure will often find that the recovery validates what panic obscured. Embracing fear as opportunity does not mean dismissing risk, it means reframing it. Volatility is not the enemy, it is the price of admission for outsized returns. Markets will always oscillate between euphoria and despair, but progress follows a more consistent path. When the noise is loudest, it helps to ask, has the core story changed, or has emotion just distorted the signal? In most cases, the fundamentals of innovation remain intact even when sentiment collapses. Ultimately, moments of fear are invitations to think differently. When others see crisis, the contrarian sees value being reset. The investor who can remain calm while the world panics becomes the bridge between today's uncertainty and tomorrow's prosperity. In that quiet space between fear and foresight, true wealth is built. In every market cycle, the difference between those who merely survive and those who build lasting wealth comes down to three forces: cash, conviction, and discipline. They are the antidotes to emotion, the compass that guides rational decision making when chaos dominates the headlines. Markets don't reward panic, they reward preparation. Yet every downturn reveals the same pattern. Emotional investors chase momentum on the way up and flee in fear on the way down. What remains consistent through the noise are the investors who entered the storm with liquidity, clarity, and the courage to stay the course. Cash, in its purest form, represents optionality. It's not about hoarding or hiding, it's about positioning. Holding cash isn't an act of fear, it's a strategic decision to be ready when opportunity knocks. When markets decline sharply, assets don't just fall, they reset. Valuations compress, sentiment collapses, and the future becomes mispriced. Having liquidity in such moments transforms an investor from a spectator into a participant. While others are forced to sell into weakness, those who preserved capital can accumulate future growth at generational discounts. Cash is a silent weapon. It buys freedom when others are trapped by margin, fear, or overextension. But cash alone isn't enough. Without conviction, it becomes stagnant. Conviction gives direction to liquidity. It is the deep understanding of where the world is heading, technologically, economically, and socially, and the confidence to invest in that direction even when the crowd disagrees. Conviction is forged through research, not emotion. It comes from studying innovation, recognizing exponential trends, and understanding that disruption often accelerates during crises. It's easy to believe in long-term themes when markets are rising. True conviction is tested when volatility strikes. That is when conviction transforms from a word into a discipline, guiding decisions that may feel uncomfortable but ultimately prove transformative. Discipline binds cash and conviction together. It's the structure that prevents emotion from hijacking logic. Discipline means committing to a plan, systematically deploying capital through dollar cost averaging, rebalancing when markets overreact, and maintaining the patience to let investments mature. The market constantly tempts investors to react, to time entries and exits, to follow trends, to capitulate when volatility spikes. Discipline resists that temptation. It's not about perfection, it's about process. Even the best strategy fails without consistency. A disciplined investor understands that compounding works not through brilliance, but through persistence. Emotion, however, is the eternal adversary. It whispers in extremes, greed during rallies, fear during declines. It disguises itself as logic, convincing investors that the current moment is different. But every major market panic in history has followed the same psychological arc: euphoria, complacency, fear, capitulation, and recovery. The disciplined investor steps back from this emotional cycle and sees the bigger picture. They understand that volatility is not a verdict on value, but a reflection of collective sentiment. Emotion reacts to the moment, conviction responds to the vision. The greatest investors aren't those who predict the next move. They're those who prepare for all outcomes. Cash ensures survival, conviction ensures direction, discipline ensures endurance. Together, they create a framework that turns fear into fuel. When markets crash, this triad becomes a stabilizing force. Liquidity allows you to buy, conviction tells you what to buy, and discipline ensures you stay invested long enough to benefit. Without these, emotion fills the vacuum, and emotion always overpays at the top and sells too soon at the bottom. When fear dominates, these principles separate chaos from clarity. They remind us that wealth isn't built by reacting, it's built by anticipating. Every crash resets the playing field, transferring assets from the impatient to the patient, from the emotional to the disciplined. Those with cash to deploy, conviction to act, and discipline to endure don't just recover, they thrive. In every market downturn, they emerge stronger, proving once again that patience and preparation are the real engines of compounding. Periods of economic stress often reveal the true engines of progress. When markets contract, capital tightens, and sentiment turns defensive, innovation doesn't retreat, it accelerates. Downturns strip away excess, exposing inefficiencies and forcing adaptation. They push industries, entrepreneurs, and investors to think differently, to evolve, and to build solutions that thrive not in abundance, but in constraint. Every technological revolution, whether the internet, renewable energy, biotechnology, or artificial intelligence, has been tested through crisis. The crucible of downturns separates the speculative from the transformative. When easy money fades, the market stops rewarding growth at any cost and starts rewarding innovation that delivers real value. That shift in capital discipline becomes a filter. Companies built on hype and leverage struggle to survive, but those grounded in scalability, purpose, and technology rise stronger. Economic contractions act as the great equalizer, redirecting attention from short-term profits to sustainable disruption. In these periods, true innovators gain market share precisely because they can do more with less. Efficiency becomes not an option but a competitive advantage. What emerges from the ashes of contraction are business models built to last, not just to impress. Innovation thrives under pressure because necessity accelerates creativity. When challenges multiply, so do breakthroughs. Energy crises birthed renewable technologies. Financial collapses gave rise to decentralized finance. Global disruptions accelerated digital transformation. When the old systems reveal their fragility, the new ones rush to fill the void. Entrepreneurs who see beyond the crisis recognize that the very cracks in the system are the entry points for innovation. They build the next wave of value creation while others focus on preservation. Investors often underestimate this dynamic. During downturns, they fixate on declining earnings and falling stock prices, overlooking the deeper structural shift underway. Innovation compounds quietly, even when markets fall. R&D doesn't stop because the S&P is down. Engineers don't stop designing because liquidity tightens. In fact, teams that survive downturns often emerge with sharper focus, leaner structures, and stronger products. For investors, that means opportunity lies not in chasing recovery headlines, but in identifying which technologies or business models will define the post-crisis world. Every major economic reset creates a redistribution of power. The companies that dominate after the downturn are rarely the same ones that led before it. This is not coincidence, it's evolution. Market leaders that fail to innovate become victims of inertia, while startups and disruptors adapt faster, taking advantage of changing consumer behavior, cost efficiencies, and technological breakthroughs. Downturns level the playing field, giving visionary companies a chance to leapfrog incumbents burdened by legacy systems. Investors who align with these shifts early don't just capture growth, they capture transformation. Innovation during a downturn isn't about optimism, it's about realism. It's about recognizing that human progress doesn't pause for market cycles. The long-term trajectory of technology remains exponential, even if short-term sentiment is cyclical. Artificial intelligence continues to evolve, clean energy continues to scale, and digital infrastructure continues to expand regardless of GDP fluctuations. For those willing to look past the noise, these trends represent compounding forces that reshape entire economies. Transformational change doesn't wait for confidence to return, it builds it. Every crisis redefines priorities, how we work, consume, communicate, and invest. The innovators who respond to those shifts early set the stage for the next era of prosperity. Investors who understand that innovation is not seasonal but structural will view downturns not as interruptions, but as accelerators. While fear drives many to retreat, visionaries step forward. They see that markets are temporary but progress is permanent. Downturns, paradoxically, become the birthplace of new frontiers. the moments when bold ideas find their footing and when transformation ceases to be optional. In those moments, innovation doesn't just survive adversity, it uses it as the very fuel that propels it forward. When markets fall into chaos and fear dominates every conversation, most investors fixate on one objective: survival. They cut exposure, hoard liquidity, and wait for certainty to return. But by the time certainty arrives, the opportunity has already passed. The investors who outperform over decades are those who think beyond survival. They don't just shield their portfolios from drawdowns, they position them for the recovery that inevitably follows. Market history is clear. The greatest gains are not earned in moments of calm, but in the rebound that emerges from despair. A downturn is not the end of the cycle, it's the transition point. Recessions cleanse excess, reprice assets, and reset expectations. They dismantle the speculative noise that builds during periods of exuberance, revealing the genuine foundations of growth. For the forward-looking investor, this cleansing process is not something to fear, it is something to prepare for. When everyone else is retreating, capital deployed into fundamentally strong assets becomes the foundation for future outperformance. Thinking beyond survival means looking past the immediate pain and seeing the structural shifts that will define the next expansion. Building for the rebound begins with understanding that every crisis accelerates change. Consumer behavior shifts, technology adoption speeds up, and outdated business models fade faster than before. Companies that adapt during contractions position themselves to dominate in the recovery phase. Investors who identify these adaptive leaders early benefit disproportionately. The rebound doesn't reward those who simply waited, it rewards those who built. That requires conviction and patience, but above all, perspective. The goal isn't to avoid short-term volatility, it's to capture long-term transformation. Market sentiment moves like a pendulum, swinging from optimism to despair and back again. When the pendulum reaches its extreme of fear, valuations disconnect from fundamentals. That's when the seeds of the rebound are planted. Those who continue to allocate capital in these moments, systematically, intentionally, without emotional interference, harvest the outsized returns later. Building for the rebound is not about guessing the bottom, it's about ensuring you're invested when the recovery begins. The timing may never be perfect, but the discipline to stay positioned always pays off. It's also essential to recognize that the nature of recovery is asymmetric. Losses and gains don't mirror each other. Missing the first 10% of a rebound can mean forfeiting the majority of long-term returns. That's why the most effective investors design strategies that endure through cycles rather than react to them. They diversify intelligently, maintain liquidity for tactical moves, and continue accumulating exposure to sectors aligned with long-term structural growth, innovation, energy transformation, digital infrastructure, and next-generation manufacturing. These are the engines that power the rebound, often long before sentiment catches up. The mindset shift from defense to construction requires courage. It's not easy to think expansively when the world feels like it's contracting. But every major technological revolution, the rise of the internet, the smartphone, cloud computing, renewable energy, was accelerated by a crisis. The companies that led those transformations didn't just survive downturns, they used them to scale. Investors who recognize those moments early captured decades of compounding advantage. This pattern will repeat because human progress is resilient. To build for the rebound means accepting volatility as a cost of participation in long-term growth. It means viewing uncertainty not as a barrier, but as an entry point. Markets reward foresight, not fear. They reward preparation, not reaction. While survival focuses on minimizing damage, building focuses on maximizing potential. The difference lies in vision. One looks for safety, the other looks for transformation. When the next downturn comes, it will again feel unprecedented. Every crisis does. But as capital flees and headlines warn of collapse, remember that the foundation of the next expansion is being laid in that very moment. The investors who see that truth, and act on it, won't just endure the storm, they'll emerge from it positioned for the powerful, compounding rebound that follows.